Carrasco, and I'm here with Nick Proud. We are both wealth managers at Confluence Financial Partners. This morning, on this Giving Tuesday, we thought it was appropriate to discuss some strategies around charitable donations and how to make giving simplified. Giving USA puts out a report every year that tells us how much money people are giving away to charity. In 2022, there was nearly $500 billion given away to charity, to include operating charities as well as private foundations and donor-advised funds. It's a large number, but believe it or not, it's almost 4% less than the year prior. We rarely see charitable giving decline, but if you think about it, it does make some sense. In 2021, we were dealing with a pandemic, social justice issues, trying to figure out how to make sure we are giving back to these causes that are coming up, and the market was doing pretty well. So people were giving more. Then in 2022, the pandemic was getting better. We weren't as worried or concerned. We're seeing the market decline. The S&P was down by 20%. We saw high inflation, so people felt they had less to give away. So while there was a drop, it wasn't a very large drop, and that's what's important to recognize here, is that even in years when there was so much going on, people are still giving in major ways. We also saw that most of the giving was coming from individuals, 64% to be exact. They were giving into all different areas of focus. One area that saw one of the biggest increases is the foundations bucket, with an over 10% increase. This includes private foundations and community foundations, which have donor-advised funds. We're now going to talk through several different giving options, including charitable trusts, private foundations, and donor-advised funds, or DAFs. These are the most popular giving strategies that we see our clients here at Confluence utilize today. Among these giving options, they all have some shared benefits. First, they're going to help you reduce taxable income. They're going to allow you to avoid or defer capital gains on appreciated securities, which is a really big factor. Strategic timing of charitable gifts. It's that time of the year when we're getting ready to be concerned about how much income did we have this year, how many deductions do we need to recognize. Using some of these vehicles will take the stress out of making donations to charities before you've decided who you want to give that to and really commit to those charities. You can strategically time so you get the tax deduction now by parking it in one of these vehicles, and then you can make the grant decisions later. These are also good solutions for managing high concentrations. If we have a philanthropic client and they're trying to work through some concentrations in their portfolio, giving away some of those assets is a really nice way to help that client out. Simplified giving for that donor that's giving to 40 different charities a year. We have a solution to simplify that for them. Tax-free and reduced tax growth on these assets. This is important to these donors, especially the next generation that want to start maybe a smaller giving account and see it grow into a meaningful number that they can possibly give to maybe their alma mater when they retire or something of significance like that. Lastly, leaving a legacy is one of the biggest aspects of philanthropic planning. So helping our clients understand this as a way for them to pass their values down to the next generation and make sure that their community remembers them as someone that was very giving. With a charitable remainder trust, or CRT, the donor puts their assets into the CRT and earns an immediate partial tax deduction. They also determine an income stream to go back to themselves or another recipient. That will last for a certain term or until the death of the grantor. At the end of that term, the remainder is then passed to the named charitable beneficiaries. The partial tax deduction is based on the estimated amount that is earmarked to go to charity. CRTs are best for those looking for a way to reduce taxable income while still providing an income stream to themselves and/or beneficiaries. It is available as a CRUT, a charitable remainder unit trust with fixed payments, or a CRAT, which is a charitable remainder annuity trust, and those are with annuity type payments. CRTs are similar to charitable gift annuities, which are sometimes offered by community foundations and other programs, but they offer more investment options and more flexibility on the number of beneficiaries. The charitable lead trust, or CLT, is essentially the reverse of a CRT. It leads with the annual payments of to the named charities, and then at the end of the term, the remaining assets go back to the named family members or other beneficiaries. The donor earns a tax deduction on the amount set to go to the charity, but is ultimately able to keep the asset in the family. CLTs are best for those looking to reduce their taxable income, but keep an asset in the family, but also be able to support their favorite charities in the meantime. Maybe property that's increasing or concentrated stock positions that they like and want to pass down. And private foundations, they're essentially a charitable entity that you create and run. It's privately funded. You create a board and policies. You have formal board meetings. You're responsible for filing its 990. You make grant decisions, including granting out at least 5% of the foundation every year. These can be attractive for the status it can bring to your giving, more flexibility in your grant decisions, like creating your own scholarship fund and selecting the student recipients based on criteria. These can be a great solution if you're looking to run your own charity or have a family member do that. Like charitable trusts, they usually start with at least $1 million. Okay, so there are some of the important things to keep in mind if you're considering starting your own private foundation. So they are, like we said, a separate entity. There's a lot of words on this page, but the main thing you need to make sure you're aware of is there's a 5% distribution requirement every year. When the assets are invested in the private foundation, regardless of whether they grew or didn't grow, the private foundation is required to distribute 5% every year. That can go towards paying your CPA to do the taxes, a family member that's running it, the meeting expenses for the board getting together, but it's supposed to be going to charity, to public charities. Private foundations are required to distribute assets to public charities, just like donor advised funds. And we can talk about that in a minute, but they can create their own programs. They can be operating charities, and they can go all the way to creating their very own. Private foundations are very involved. So the status of having a private foundation can be achieved through a donor advised fund more simply, easily, and with less expense, and it's usually a better fit. The opportunity is with a donor advised fund, but they do make sense in the right family. One point to mention is if we do have kids running the private foundation, there is a burden on the private foundation to make sure there's no conflict of interest. They're actually doing the work that they can demonstrate so that they deserve to get compensated for their work on that private foundation. The donor advised fund, or the DAF, is by far the most popular giving vehicle, where it makes sense for nearly 95% of family situations. It's an account within a public charity. Raymond James started Raymond James Charitable over 20 years ago as a public 501c3. It's not an affiliate or subsidiary of Raymond James. It's its own separate public charity with its own board of trustees within this charity. It offers a donor advised fund program. When you make a contribution to your DAF, you earn an immediate tax deduction on the fair market value of the gift. Then you can decide later on at any point to make a grant to any of your favorite charities. When the funds are in the DAF, they are invested and grow tax-free. So hopefully you're giving even more away to charity. You can also set up a succession plan for your DAF, so you can either name family members, friends to take over the account and make decisions on the grants if you pass away, or you can name specific charities to receive either a lump sum of the balance or a percentage of the balance, essentially creating a perpetual gift. So why do people use these? Again, you can take the tax deduction today and make decisions later on about who you want to give the money to. We have a lot of clients that are selling their business. They're getting into a stressful situation. They know they need that tax deduction now, so they can put those assets into this account. Or the client that has concentrated positions, they can put those assets into this account. Instead of getting marketable securities to a public charity that's operating, they can split that money out. So they put their assets into the donor advised fund. We sell them, liquidate them, reinvest them into whatever strategy they've chosen for their DAF. And then that money is available to be split among multiple charities. But they get to make those gifts in marketable securities without paying a tax on the capital gain because they gifted it to charity. And the charity is the one that's selling it. We've also seen a lot of clients that are giving away maybe $2,000 or more a year, and this is a really good solution for them. We know that the standard deduction is very high, so while giving $2,000 a year is great, you are not recognizing any deduction for that gift because you're probably taking that standard deduction. But if you bunch your giving over the next several years and fund that donor advised fund with, say, let's say $10,000 this year, then you can go ahead and itemize this year, and you're going to get over that hump, and you're going to be able to deduct more. But that way you can continue to give to charities the same way you always have, just giving that $2,000 a year because it's already in that DAF. We also see a lot of people opening these accounts because they want to be anonymous. A lot of big philanthropic donors, if you want to give to a certain charity and maybe you don't want your name on that tax return, it's your very private, very important charity, maybe to you, and you don't want any judgment, so you can use a donor advised fund to put the assets into the charity. And lastly, a lot of people are running these accounts just like they would a private foundation. Additionally, DAFs are helping build that legacy, and it's helping bring families together, making things simple and easy. So there are restrictions to be aware of with DAFs. The biggest being that there can be no personal benefit associated with a grant out of the DAF. You can't use it, for instance, to buy a banquet table for $9,000 and then sit at that table and eat a chicken dinner. We have this rule with the IRS, even if the chicken only costs $25 and the rest of, let's say, $9,000 is going to the charity, you cannot use the donor advised fund to make those gifts. So make sure if you are doing these types of events that you hold that money aside instead. What you also should not be doing it or using it for are binding pledges. So if you are looking to make a commitment to an organization and you promise to give a certain amount of dollars every year or at a set period of time, we would have to talk about how to do that the right way. It's not that it can't be done, but once the pledge is already in place, it's too late if you've made a legally binding pledge. That pledge is now between the donor and the charity, and the donor advised fund, Raymond James Charitable, can't get into the middle of that after the fact. It can't be used for lobbying or political campaigns, and it has to go to a public US-based charity. That's why you're getting a US tax deduction for funding it. So any international giving, again, it's not that it can't be done, but we have to make some workarounds and give it to another organization that then gives it to the international entity. So it's a little more complicated. You just need to be aware of those types of things. You can have multiple donor advisors on an account. You do not have to be the person funding the account, be the donor advisor on the account. So for instance, grandma can open the account, grandkids can be the donor advisor, and anybody can fund these accounts. We have lots of these accounts open. For instance, when someone passes away, you maybe want to set it up as a memorial. You can have it in lieu of flowers. Please fund our family's foundation. And that's perfectly fine. And we also allow smaller donations in those scenarios as well. And there are also some investment options to pick from. One thing I didn't talk about really is succession. So what happens if you die and there is a balance in the account? We ask for you to name a successor donor advisor that would make the grant recommendations for you. Or you can name charities specifically that you want Raymond James Charitable to make the distribution to all at once or over a period of time. One of our largest accounts was funded at the death of a widow who had no heirs. She was very philanthropic and was giving money to charity. She started the account while she was living with just $25,000. It was very easy to use, and it helped her to keep automatically sending the grants to the charities that she wanted to. And then when she died, she funded it with $25 million. And the fund is still making those same distributions in her name to those charities to make sure that her legacy lives on. And the charity continues to get the funding that they were used to getting while she was living. So it's a really great option, especially for someone who doesn't have heirs. I'm going to turn it over now to Nick, and he is going to expand on some of the factors to think about when choosing between the different giving vehicles.
Thanks, Melissa. So some factors for choosing between vehicles. There are a lot of options between charitable trusts, private foundations, and donor advised funds. It's important to think about these factors to help determine the best vehicle for you to utilize. Some good exercises to work through would be: how much do you want to give? How much do you want to control? And what do you want to give? What kind of recognition are you looking for? Are you trying to start your own program? How involved do you want to be? What is your time horizon? And how important, excuse me, is the tax savings goal? All the answers to these questions is going to help ensure that we put our clients in the right vehicles. So private foundations versus donor advised funds. Here's a closer look at how private foundations and DAFs compare, as they're the most common and most often compared to one another. Two important highlights. One, the minimum for a private foundation is typically $1 million versus a DAF that ranges from $5,000 to $10,000. Two, the private foundation can dissolve into a DAF. However, the reverse is not permissible per the IRS. If you currently have a private foundation and want a second opinion on if that still makes sense for your situation, we certainly welcome the opportunity to learn more about you and help guide you in determining if a private foundation still makes sense or dissolving into a DAF is the best path forward. So program specifics for donor advised funds. You can establish a DAF with as little as $10,000. You can add to your DAF with as little as $500. The minimum grant out to a charity is $100. Typically arrives to the charity between 1 and 5 business days. RJ Charitable has done a lot of great work in automating the grant process, which is excellent for our clients as they have one of the fastest turnaround times in the industry. So let's talk about some donation strategies. We'll talk through several different donation strategies. The first one being donating appreciated stock. When you donate appreciated assets, there are some added benefits as compared to just donating cash. You not only earn the tax deduction, but you also avoid the capital gains that you would have owed if you sold the stock first, then donated the cash. I'm going to run through a couple of quick strategies as well for giving. We already talked about donating appreciated stock and avoiding capital gains. This chart is helpful to show the clients exactly what that means for them. So in this scenario, they purchased stock at $5,000. It now has a value of $25,000. Long-term capital gains tax rate on those assets would be 15%. If you were to sell that stock first, then make a gift to a charity, they would be saving about $2,280 in taxes. Their charitable deduction amount would be $22,000, and they'd have to pay capital gains tax. If they instead gifted those assets directly to the charity and the donor advised fund, now they're not paying the capital gains tax. Now they get a charitable deduction at $25,000, and then their tax savings is $6,000. You can imagine how much these numbers really get meaningful when the donation is much higher than $25,000. Now, non-cash donations in 10 easy steps. There's also the opportunity to donate non-cash assets like real estate, privately held shares, and many other types of illiquid assets. If you're considering selling a private business or going public, incorporating a gift to a DAF of a portion of those assets would help avoid capital gains and earn the business a charitable tax deduction based on an appraised value of the shares at the time of the gift. We help facilitate these types of gifts through a third-party partner called Charitable Solutions. They're the experts in this type of donation. And once the assets are in liquid form, they'll transfer the remaining balance to your RJ Charitable DAF for you to make a grant recommendation to your favorite charities. Another donation strategy would be a Roth conversion with a donor advised funds. You can incorporate a DAF at the time of a Roth conversion. This is a great way to incorporate charitable giving into your life during your retirement years. When converting to a Roth, it's a taxable event. Therefore, you can offset some of those taxes with a gift to a DAF, essentially front loading that DAF with the assets that you can then gift out in the future when you support your favorite charities. Qualified charitable distributions. If you have a lot of assets in your IRA and you're of the age to take a required minimum distribution, you can avoid some tax by utilizing a QCD. You can give up to $100,000 to a charity without getting tax on that distribution. Now, keep in mind that QCDs are not eligible to go into a DAF or private foundation, and instead must go to an operating charity. Note that you don't have to earn a tax deduction by using the QCD, but it can still be a good strategy to avoid some of that tax or that taxable income. The last donation strategy that we're going to hit on today is bunching. If you're close to the threshold of being able to itemize, bunching to your charitable gifts into a single year could help you get over that threshold and take a higher donation in that year. In this example, without bunching, the client is never reaching the standard deduction threshold, therefore never able to itemize and take a higher deduction amount. When they're incorporating bunching, they're still giving the same $40,000 over 4 years. They're just bunching the gifts into 2 of the 4 years. In those 2 years, in 2023 and 2025, they've gifted enough to be over the standard deduction threshold and take a higher deduction amount, ultimately resulting in more than $10,000 in deductions as compared to not bunching at all. So can I transfer a DAF to a Raymond James charitable account? DAFs are easily transferable from program to program. It's just like making a grant to any of your favorite charities. In this case, the charity recipient is Raymond James Charitable. All you need to do is open a DAF here and then submit a grant for the balance at the other DAF program. So lastly, which DAF program is best for me? All in all, it's important to uncover these considerations when contemplating the best DAF program for you. Key things to consider when comparing programs: confirm the assets are worth it, understand minimums for contributing and granting, investigate investment options, and uncover any and all grant restrictions. So thank you for taking the time to learn more about charitable giving. If you'd like to expand upon our conversation of Giving Simplified or have additional questions, please feel free to contact Melissa or me. We look forward to connecting with you and helping you think through what is the best path forward for your situation.